And the U.S. economy growing faster than expected in the fourth quarter of 2018, helping give those numbers a boost for the full year. Kevin Hassett is the chairman of the White House Council of Economic Advisors, and he joins us now. Chair Hassett, thanks for joining us today. So the administration putting in that 3.1% number for 2018. We saw a 2.6% annualized growth rate in the fourth quarter, slower than the overall year, but the best year for the economy since '05. What was your take on today's report and just the year looking back at 2018?
Well, I think if you look back at the year, the interesting thing is that it worked just about exactly the way we expected, which in economics, of course, that almost never happens. But if you go back to about 16 months ago, the CEA, we put out an estimate for 2018 where we said if the tax cuts pass, I mean, we've talked about it on the show, right? If the tax cuts pass, then we'd get 3.1% growth in 2018. That was our forecast, 16 months ago, and it would be led by capital spending. If you look at capital spending, it really accounted for a disproportionate amount of the growth as well. The capital spending happened because of the tax cuts and deregulation. And so I think that basically we got a year that we expected. And so you asked, well, what about 19? I think the reason why we're looking ahead to a good 19 as well is that the model that told us 3.1 way back in the day, even before the tax cuts were passed, says this year is going to be 3.2. And, if the model worked well last year, I think it actually should make our faith a little stronger in the model.
So it worked well last year. You say you're looking at a good 2019. I mean, it all looks great. Do you think the Fed's making a mistake by being patient then here?
I think that, first, I totally respect the independence of the Fed, and I think that the president does too, and that's why we've appointed such great people there. But I think as an economist, I can talk about the economy and the numbers. And one of the things that I think that is obvious to people who've been in Econ 101 is that if you get a lot of growth because of a supply shock, if you shift the supply curve out, then that puts downward pressure on prices because you got all the supply competing to, for sales with consumers. And so I think that we just had a supply shock year, big time. The capital spending was through the roof. That puts downward pressure on prices so that you could have high growth without creating the kind of runaway inflation that, would rightly cause concern at the Fed.
Kevin, you mentioned that your thinking is pretty positive for 2019. The model is in place, 3.2%, I think even mentioned, is perhaps in the cards. But really, I mean, it's not so simple as set it and forget it, right? I mean, don't you guys have to implement more policy? And then the question is, what more policy can you actually put into place?
Right. Well, I think that if we were to look back at our 3.1% forecast way back in the day, that we had about, an extra 0.5 above trend because of the tax cuts, and the rest was because of deregulation. I expect that the tax cut part is going to continue to give, but don't forget that, President Trump's deregulation agenda can happen without Congress intervening. It's basically we just go thing by thing and make it smart. And if we do that, that really improves business sentiment. And so one of the things, for example, that in this year is a real positive, upside risk is that there are a lot of regulations, especially, say, at the Labor Department, that people have been studying and thinking about how to revise in order to improve the business climate. And that can continue even if we're in a Washington where, getting things through Congress seems difficult.
Now, something that investors are certainly thinking about is where the global economy goes in 2019 and how that could affect U.S. businesses and the U.S. economy. So from where you sit at the CEA, how much are you guys thinking about how the global economy, if it does indeed slow down, as some have forecast, if China's economy continues to slow down, how much you think about how that could impact the U.S. in 2019 and beyond?
Right. Well, it's a great question. And I think that the first thing that you have to think about is that there are really two poles right now that we have to pay attention to. There's Europe and there's Asia. Let's start with Europe. Europe is really in a sharp slowdown. If you look at Germany, for example, they've had 3 out of the last 5 quarters have been basically recession territory. And I think that kind of slow growth, something of a surprise to markets because it was so strong about a year ago, is probably related to a couple of things. Most importantly, uncertainty over Brexit. Maybe it's 3 things: uncertainty over Brexit, uncertainty over the EU elections, and some, serious financial problems in Italy. And so I think all of that has sort of cast the pall on people who might want to, say, invest in a new factory or something in Europe, and you can really see it in the numbers. In Asia, I think that trade uncertainty has been a big negative for China, and that might have spread a little bit outside of China as well. And I think that that's another big upside risk for the year because we are making tremendous progress in the China trade negotiations. Ambassador Lighthizer just testified, and he went through a bunch of the positive agreements that we've already made. And so I think that if the China trade dispute resolves, in a favorable way, then that'll really help the Asian economy and provide, some extra steam to the global economy as well.
So some people say all that steam that we got in 2018 was due to tax reform and the sugar high that we're not going to get in 2019. And there have been a lot of headlines about what refunds are looking like right now. And the U.S. Department of Treasury, the Office of Public Affairs, actually just came out with a statement saying that average tax refunds are up 19% from last week and that they're consistent right now with 2018 refunds. So when all is said and done, what do you think the picture is going to look like for refunds this tax season?
Yeah, so don't forget that if you're getting a refund, then what that means is that you overpaid your taxes last year. And so one of the things that President Trump and Secretary Mnuchin prioritized right after the tax cuts were passed were changes to withholding so that people's checks changed right away. And so if you look back already in February of last year, people got their tax cuts in their paychecks and started to have that money to spend on things. And I think one reason why we had the 3.1% growth over the last 12 months is exactly that the tax cuts began to really show up in people's checks in February. And so you'd much rather have your money now, right, than a year from now. And so the refund is basically what happens when you over withhold and then have to get some money back from the government, which you get back, by the way, without interest. And so the withholding thing, I think, is something that has been used a little bit by the left to make it seem like the tax cuts aren't working. But if you just, study the math, basically probably what's going to happen is that there'll be a little bit of over withholding, just like there always is. But that the big news is that there were these big tax cuts that gave us 3% growth that people said were impossible, that was impossible. And the tax cuts went to people in February. And that's why the refunds now, haven't gone up a lot because of the tax cuts. Because the whole point is not to make refunds higher. The point is to make your check higher, your paycheck higher after tax.
Quick last question. So that 3.2% number you mentioned, that's something you guys really think is possible for this year?
Yeah, I mean, that's right now the anchor forecast for us. And I know that that's above the market, but it's about the same amount above the market that we were last year at this time. And just remember that we've got the capital spending boom, right? You've seen it. Yeah. And when you build more factories, then what happens in the next year is those factories start to produce output, right? And so if you think about it, the capital spending boom last year should increase output this year, and the capital spending boom will continue as well. And so I think that there's a lot of reason to believe that the momentum that we see is continuing into this year. Final thought on that is that, remember, January jobs numbers were above 300. And it's pretty much usually the case that if you get a jobs number in the first month of a quarter above 300, then that quarter gives you growth above 3%. I think Q1 might be a little weaker than that because there's this weird seasonal issue that you guys have probably talked about. But I think that we're really looking like we're on track for a 3% year.
All right, Kevin Hassett, chairman of the White House Council of Economic Advisors. Thanks so much for your time.
Thanks for having me, guys.